This is the 703rd meeting of the Economic Club of New York, and I'm Barbara Van Allen, President and CEO of the club. The Economic Club of New York has been recognized as the nation's leading nonpartisan platform for discussions on social, economic, and political issues for more than a century. So it's wonderful to be here today, continuing that tradition. I'd like to extend a warm welcome to students from Rutgers University, Columbia Business School, the Gabelli School of Business at Fordham, who are joining us virtually today. We also have some members of the largest ever class of 2023 ECNY Fellows, a select group of diverse, rising, next-gen business thought leaders. I'm really honored to welcome our special guest today, fellow member and club trustee, Lee Ainslie. Lee is the founder and managing partner of Maverick Capital. Before founding Maverick in 1993, Lee was managing director of Tiger Management. In addition to serving on our board, he serves on the boards of the Robin Hood Foundation, the New York Presbyterian Hospital, the Episcopal High School in Alexandria, Virginia, and on the executive committee of the Partnership for New York City. He received a BS in Systems Engineering from the University of Virginia, where he was a Westmoreland Davis Scholar and Thomas Pinckney Bryan Jr. Scholar. And his MBA is from the University of North Carolina, my alma mater. And he was a Beta Gamma Sigma member. The format today will be a conversation in which we're delighted to have Chief Economic Reporter for the Wall Street Journal, Nick Timiraos, doing the honors of moderating. As a reminder, this conversation is on the record. We do have media on the line and in the room. Nick, if you're ready, the mic is yours. Both of you, if you could just come forward. Thanks.
Well, thank you all for joining us today. Lee, thanks for being here. I guess maybe the place to start is if you look back over the last 10, 15 years, what have been, in your view, the most notable changes in the hedge fund industry? You know, if you were sitting here 10, 15 years ago, things you wouldn't imagine, things that have caught you by surprise?
Well, I'll answer from the perspective of long-short equities. That's what Maverick Capital is primarily focused on over the years. And now, of course, hedge funds represents a lot of different investment strategies. But if you think about the role today versus 15 years ago really being the midst of the financial crisis, at that point in time, most long and short funds were rather concentrated, maintained relatively low levels of exposure, and indeed got through the financial crisis, still many losing money for the first time as our first down year in our history, and yet doing a much better job of preserving capital than the markets did. Well, you compare that to last year, most fundamental long and short funds actually performed worse than the S&P. Now, some of that is due to some structural reasons, energy being the best performing sector, most long and short funds not having a lot of exposure to commodities, including energy, growth and quality are the two worst performing factors. Most fundamental funds tend to gravitate towards stocks that represent growth and quality. But I think most importantly, most long and short funds, the lesson of since 2009, thank you to the Fed, is to not be short and to have higher and higher levels of net exposure, to have short exposure achieved through ETFs and index mechanisms as opposed to individual stocks. There was an exclamation point put on how hard it is to short individual stocks in January of 21. And so I think as we walked into the challenging period last year, most fundamental long short funds were simply not prepared for that type of environment, and it showed in their performance. And the other big change since that time is the rise of the pod model, Millennium, Citadel, where they have many, many different investors investing in a rather limited way in terms of the types of risks they're allowed to take, lever that up pretty substantially and run the center book, et cetera. And that's generated very steady returns, albeit not very exciting returns. And it will be interesting to see in a world where you can get yield in a lot of different ways, how those returns, especially because they're rather tax inefficient, compare, and therefore how that model does in the world today. But it's been an interesting period of time without question.
So to go back a little bit, there's a story that you got into investing when you were in the 8th grade, joining a high school investment club. People have talked about that as your start in this business. How did that come about?
So my father was the head of a school in Virginia, which, interestingly enough, my brother now runs that schools as the head. And back then it was a 7th grade to 12th grade school. Now it's 9th through 12. There was an investment club that was being formed for the high school. As I became attuned to that, I asked if I could participate, and they let me do so. And that was really my introduction to stocks. Again, my father was an educator. And even back then, I really found it to be interesting, fun, informative. And so I kept a paper portfolio from 8th grade all the way through to I finally got through business school and paid off my loans from the first time I had an actual account. But I had probably more than a decade of trying to trade on paper.
But you got your degree in college in engineering. So how did you get pulled into finance?
So I think about halfway through my 2nd year of college, what I recognized about engineering is I did not want to be one. And yet at this point, I was already committed to that path. It would have been hard to change my major. And so I did minor management and what they used to call MIS, Management Information Systems. That's a term that's faded by the wayside over the years. And then my first job was as a consultant, and I was working at a firm that grew through acquisitions that period of time, ended up working on a lot of those deals. And that was sort of an introduction to finance. Got to business school, was asked to work with the board on a couple of things. Julian Robertson was on the board, and he and I got to know each other through that. And we used to talk about stocks a lot. Again, at the time, I saw a very active, paper portfolio, and I recognized, this was sort of like talking about basketball and Michael Jordan. This was just an unusually wonderful opportunity. And I had accepted a job to go to Goldman Sachs, and about a week later, Julian asked if I would think about going to Tiger instead. And at the time, Tiger was managed $407 million and had a handful of employees. It was sort of a different world. But again, the thought that was someone was going to pay me to do my hobby was pretty exciting.
And so you were there for 3 years.
Mm-hmm.
Was it? And you left in 1993 to start Maverick. I imagine that was difficult to leave, but walk me through that. They try to talk you out of it. You decided to stay. How did that go?
Oh, in between getting really mad at me and trying to get me to stay, it was an interesting back and forth there for about a week. But no, I had no intention of leaving. I was treated extraordinarily well. And there was a group that wanted to start a new fund and approached me to lead that effort. And I said no 2 or 3 times. And every time I said no, they came back with something that was more attractive. And I did finally conclude that the odds of someone really having the complete discretion, having a portfolio and a track record that they felt ownership of at Tiger was really never going to happen. That's just not the way Julian made every final decision. By the way, he was pretty good at making those final decisions. So there wasn't a lot of motivation to change that model. And I had some trepidation. It was pretty clear to me I was not really prepared to take on that kind of responsibility. But the more I thought it through, I concluded, but wait a minute, 2, 3, 4, 5 years from now, when you do want to take on this challenge, the odds of finding something as attractive as these folks are putting together for you is going to be really, really slim. And so I made the decision to make that change and had some interesting interaction with Julian at the time. And we weren't on very friendly terms for a few years, but by the late 90s, probably 97, 98, Julian very kindly reached out and we started spending a lot of time together and once again became very close.
So shifting gears, Maverick's done a lot in tech. Over the last 20 years, there was a view that software is king, hardware was a commodity, not as much room for value add. And the question here is about AI. How does AI change this picture? How does it fit into this picture? Does it change that narrative? Does it reinforce that narrative?
So that you're correct. That really has been a lesson the last 30 years, I would argue, in technology investing, that software is king. And there were a few drivers of that. One, switching costs. If I walked into Maverick tomorrow and said, hey, we're not going to use Excel anymore, we're going to use Google spreadsheet, people would be up in arms. They had no idea how to use Google spreadsheet. Network effect. The reason Facebook made it and MySpace didn't, because of that network effect. And then, of course, just in terms of the capital that needs to be deployed relative to hardware, software is a far more efficient model. So the value add has been in software for a very long time. And I do believe that AI is going to flip that around for the first time in my investing career.
What do you mean by that?
So right now, OpenAI has gotten obviously a lot of the press, but there are actually 5 different private companies that do have their own models that or we've actually spent time with each of the 5. And even the ones you haven't heard of are really quite impressive. They're not where OpenAI is, but they're not too far behind. And of course, in addition to that, you have Google, which has got a lot of press. Meta has 2 different models. Huawei has a model. NVIDIA has a model. Amazon, Apple probably do. They haven't really said anything about it. So there are a lot of these efforts. And what's quite clear is the constraining factor in developing these further is computing power. OpenAI thinks they will use 10 times the computing power in 2024 than they used in 2022. And that's just to develop the models, to use the models. So if you get to the point where customers are now buying tweaked, customized, specialized version of these models to do different tasks, that will also take a huge compute demand. And it was telling Microsoft, this was public about 3 months ago, announced internally that they were going to ration time on their AI efforts because they simply didn't have the capacity to meet the demand just internally. Right now, NVIDIA has a rather significant lead in the type of computing, GPUs, that is required to do these type of computational tasks in a very efficient way. AMD has an effort which is pretty far behind, and yet the demand is so great. They also are starting to see a pretty significant tailwind. And so I think at least for the next several years, that's going to be the bottleneck. And that's going to be where the value add really is, because some of those drivers to the value add being driven by software changes in this world. So switching costs, well, you can talk to one of these just as easily as you can talk to the next one. There's no training involved. Network effect, there's some network effect, but even versions that are pretty far behind OpenAI, for most tasks, you would not be able to tell the difference. So in this world, actually, maybe being 80% as good is good enough because it's still pretty amazing. And so I really think it's going to be more challenging over time to drive a lot of value through the software. And we've known Sam Altman for a very long time. We were an investor in his first startup, Looped, and we were one of the early partners of Y Combinator. They ran for a while. So we've looked at OpenAI for years. And they also have sort of a strange, because it started as a nonprofit, obviously, and they've tried to find this blend of being a nonprofit and yet get enough funding for Microsoft and others to be a for-profit. But they have as a part of that, a very strange return on capital model where, as an investor, you participate in distributions of profits, but nothing else. And so the enterprise value actually is not even relevant to you. But anyway, so we ended up not investing in OpenAI, but in part because we concluded there are going to be a lot of really successful approaches, and it's going to be more challenging for one to be so dramatically better. The other old standard I think is going to be flipped around is technology 10 score standards. The reason everyone uses Excel, the reason everyone uses Google, and I think that gets changed a bit as well, just because the differentials between the different efforts are going to be difficult for most people to even detect for most tasks.
But so what differentiates one platform or one of these AIs from the other? Is there going to be, what's the value add if you don't have the one that's the farthest along?
Well, we've actually spent some time playing with ChatGPT-4 as well. And I will say the difference is remarkable. Now, it was trained on 80 times as much data or inputs. So it should be better, but as has been widely reported, ChatGPT-3 will make some mistakes from time to time. In our experience, it happens much less often. It's a little less robotic. If you play with ChatGPT-3, you know, most responses start with some form of why it's difficult to render an opinion. Here's what some people think. Here's what other people think. ChatGPT reads a little less stilted. Having said that, if I were, you know, a high school student trying to get my homework done through AI, the answer from ChatGPT-3 is going to be really good. It's going to be good enough. And so again, I think the differences between the best efforts and the B efforts are going to be small enough that most people, for, you know, not if you're trying to decode a protein, but if you're trying to write a song in the style of Taylor Swift, they're both going to do a very good job.
So are these tools going to come for white collar jobs? Will there be applications for finance? I mean, how can a hedge fund harvest some of this, you know, computer brain power?
So I'll give you a couple quotes that made me think, and these aren't paraphrasing, these aren't exact. That Henry Kissinger called AI the most important innovation in human thought since the printing press. CEO of Google said he believes over time AI will become regarded as more important to human evolution than fire or electricity. So these are, you know, if that's even partially true, those are powerful statements. To your point, it really, in my lifetime at least, is the first job destroyer of white collar jobs, and will impact finance. It'll impact everything. I mean, I really don't. I was actually at dinner last night with the founder of Robinhood, happened to be there as well, and he wants to get a committee together with the board to figure out how we're going to use AI. Should it be writing grant proposals? Should it be reviewing grant proposals? Should, you know, how do we? And I think for most things we're all thinking about for the next several years, it actually will be a productivity gain. Will make people more efficient. So the arguably the lowest hanging fruit is coding, and there are certain types of structures that you need and codes that are used consistently, repeatedly, that now they can just pull down and have AI write them for them. So does that mean those jobs go away? Eventually, but right now, most major corporations have development backlogs of 6 months up to even like 3 years, sometimes a year. And so those programmers are going to be far more efficient using AI tools. Likewise, I have a friend who's a realtor, and she uses AI now to write the description. It's a 4-bedroom house with great light, da, 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 da. Now she'll take that description and tweak and edit it. But she told me she used to spend an hour or two writing these things herself. Now it takes her about 10, 15 minutes. So I think initially we'll see throughout many different industries, just a huge, I mean, if you're a radiologist, you're going to get a screen saying the computer thinks there's a 93% chance it's this, a 4% chance it's that. And you're going to look at it and go, okay, check, right, next. And so you'll get, I'm making these numbers up, but you'll review a radiology photograph every 10 minutes instead of every half hour. So I think in almost every industry, the initial impact will be a huge pickup in productivity. But at some point, it will be different, obviously, for different roles. There will be a tipping point where, wait a minute, we don't need any more productivity. My development backlog is 0. And actually, now I just need less coders. And again, I think we start to get to that point at different times, different industries. But the skill sets, and frankly, I'll be certainly retired and probably dead by the time this really happens, but my children won't be. I have a 27-year-old, 24-year-old. In the middle of their careers, they're going to, whatever, in one, they do 2 very different things, but each of them are going to have to use AI as a tool and have strong critical thinking skills, be able to use some, you know, human creativity. But if you're, you know, a paralegal, or you're, you know, you write for a newspaper about last night's game, you are unlikely to have a job. And so that's the world that the younger generation is going to have to adjust to.
That's really confidence inspiring. I cover the Federal Reserve, and we're always reading.
It's really complicated.
Yeah, the computers can't figure out the FOMC. You know, the FOMC statement comes out at 2, and you'll just run it through ChatGPT and analyze if this is a hawkish or a dovish Fed statement. So I'll have a few years to figure out what comes after that replacement. 20 years ago, there was a lot of excitement around alternative data, data scraping, big data that would allow you to have a more timely and accurate read on sectors of the economy, different industries that weren't available. And I assume this has gotten better over time. Are there techniques you've been able to use, alternative data sources that you've found have actually provided some sort of leg up that wasn't available 10 years ago?
Yes and no. So just put it in perspective, as you mentioned earlier, I do a degree in engineering. I actually kind of worked my way through college by building systems for small businesses. And so it was always comfortable with a data-driven approach, even though we're known, and rightfully so, as a fundamentally oriented investor. Back in 2006, we started a quantitative research effort, initially just to support that fundamental effort and try to make us more efficient, more consistent, to recognize discrepancies in our views and what a traditional quant approach would suggest. But that prepared us pretty well for the world of alternative data. And we went down that path starting in 2015. And at first, it was incredibly productive. Really up to about the middle of 2018, something changed. There's something I would guess is DE Shaw, 2 Sigma, Renaissance, et cetera, started focusing on some of the things we'd already been doing. So initially, I think we had a lead because we were taking a very fundamental approach to these data sets and trying to put forth economic hypotheses and see if we could prove those and they were relevant to stock prices, et cetera. And so today it's a bit of a mixed, pros and cons, in that the amount of data, we now look at things that touch every industry. I mean, forever people thought of it as, is a retailer going to beat or miss the quarter, judging on credit card data and how much of their business is credit card, et cetera. That stuff is almost of no value because it's so easy to do, so many people do it. But now we have data sets that touch upon every single industry in which we invest, and increasingly are helping us understand margin structures as well, not just revenue trends. So that's good. And that, I would argue, helps us reduce our fundamental mistakes. But at one point in time, we could use those as alpha signals and really trade around those. And there's just, and again, AI, again, is, I'm sure, impacting this, or machine learning, et cetera. Those alpha signals are more muted than they used to be. So even if you get the fundamentals right, by the time you get it right, it has already been absorbed into the stock price. So, I mean, we're talking about minutes of, a data point gets released, how quickly it is reflected in the stock price. So you don't really hard to take advantage of it from that perspective.
So earlier on, you were talking about last year being a tough year for long short. And I realize, Mavericks, you're not a macro fund. You don't have to have a view about what, core inflation is going to be at the end of this year. But nevertheless, a lot of questions right now around, financial conditions, the bank stress event after the two mid-sized bank failures last month. How meaningful do you think this is all going to be for the economic expansion this year?
So I was chatting with someone before we walked in, and this, I'm going to preface this with, I am not uber bearish, but it's going to sound like I am. Net exposure at long short funds right now is the lowest it's been in years. Other market sentiment indicators are about as overly bearish as they can be, which is in part why I think over the last month, market actually performed fairly well in the face of a lot of tough news. Yeah, I think it's really, and to your point, this is not really what we do. We actually maintain rather conservative exposure so that beta doesn't play a big role in our return streams. But having said that, I think it's probably the most challenging time I can recall, in that there's so many different cross currents that all are important, all are at work at the same time. So going back to some of the issues you raised, so right now, at least as of yesterday, the market was giving an 88% chance that we'd raise a quarter point in May, and over 50% chance there would be a 50 basis point reduction from there by the end of the year. We'll see how that plays out. So on one hand, we have the view that inflation is going to be a little stickier than people realize. So certainly COVID, Ukraine, Russia put the pedal to the metal on inflation and part of our fiscal response to those issues. But even once that calms down, as is already happening, my thinking is that the baseline inflation underneath all this is actually continue to march upwards. Decarbonization, deglobalization, people miss just the aging of our populations. The active workforce is shrinking. That's part of wage inflation. And so I do think particularly wage inflation may be a little stickier. On the other hand, I feel that people are underestimating the longer term impact of the banking, I wouldn't call it crisis, but stressful events. So in March, you had 178 billion come out of regional banks and 100 billion go into the major banks, and 78 realized, wait a minute, I can have a money market fund and earn pretty good yield and not have these rates. But that seems to have calmed down the last couple of weeks. Actually, regional banks have had inflows, probably related to tax refunds. But I think people sort of feeling, okay, well, we got through that and that's behind me. Let's not worry about it. In reality, I would argue the response from all that works on a delayed mechanism. So all that money that flew from regionals, well, first of all, money left the banking system altogether. So it's not going to be available to the economy in terms of loans. Secondly, the capital that went from regionals to the big banks, well, the big banks use their balance sheets far less aggressively. They make loans on far more conservative terms. And then even the regional banks, whether it happens through regulation, which I think is likely to some degree, or happens just through the recognition, wow, I need to run my balance sheet in a far more conservative, thoughtful manner than I used to. Either way, that capital is going to be used in a far less aggressive way. So I do think there's sort of this long-term contraction driven by what's happening in the banking system. And part of my concern is, and the Fed can't really control that. They can't control fiscal policy. So their one tool of monetary policy is becoming a smaller part of the overall equation. And therefore the odds of a soft landing, I don't think are tiny, but are certainly shrinking. So again, as we put this all together, we're pretty happy that we don't need to be too dependent upon beta, just because I think there are some really challenging cross currents to understand.
So the Fed wants to slow the economy down when they raise rates, but I compare it to hitting the glass ketchup bottle. You keep hitting it, nothing comes out, and then you hit it that one time and everything comes out. Is there any hope, do you think, you mentioned a soft landing, of achieving a meaningful disinflation without a recession? I mean, if wage growth is sticky, if companies have rediscovered pricing power, do you have to scare them into preserving market share with a downturn?
Yeah, I would argue the odds are very low. I mean, it could happen, but as you just said, the effectiveness of the tools the Fed has at their disposal is shrinking. To really get, again, given what I just discussed, some of the underlying currents will be driving inflation higher, really get it to the point that's anywhere near their targets. It's really challenging to see that happens without a recession. And one of the challenges we started with compared today to 15 years ago, and I think Maverick's pretty typical. The vast majority of our investment team is under the age of 40. Right. And so they haven't lived through inflation. They haven't lived through higher rates, haven't lived through a recession. They think, the stock market decline over the past year has been this amazing once in a lifetime thing. Well, to put it in perspective, from peak to trough, NASDAQ was down 35%, S&P down 25%. Well, 00 to 02, NASDAQ was down 83%. And in the financial crisis, the S&P was down 57%. So what they view as this, once in a lifetime, really challenging period, they don't get it. So at Maverick, myself and some of the other old guys were spending a lot of time trying to make sure people really think through the persistent higher rates and what that does to multiples, think through what a recession can do to earnings and revenues in different businesses. There is no such thing as a recession-proof company, maybe recession-resistant. But I think you're seeing that play out across most fundamentally oriented firms where They just don't have an historical context that is helping them during this period of time.
So we had 15 years of historically low interest rates. And notably, I think in 2020 and 2021, the message was maybe getting through. The Fed was saying they thought interest rates would be lower for longer. The neutral rate of interest had declined. And so I wonder, to what extent were financial decisions, business decisions predicated on this idea that, short-term rates would maybe top out at 3%, but that we wouldn't see something like, high fours, now 5%, and that we wouldn't stay there for very long if we got there. What parts of the economy or the financial system do you worry about if we're actually going to be in a higher for longer interest rate environment or a more volatile interest rate environment?
And I think both will probably be the case. So, Silicon Valley Bank was really the headline event of a management team that clearly was not thinking through the ramifications of a very different rate environment. And I think we're much more in the mentality of making sure they meet all the regulatory requirements. Yes, we did. Okay, we're good. And indeed, they were not. And I do think that's been a wake-up call to different industries. Where it's also very interesting as you get on the private side, you can now see in hindsight, certain firms recognize, wait a minute, I can raise this much money at this valuation. That's essentially free money. Yeah, let's raise as much as we can. And certain firms, I don't really need the capital. I don't want to dilute people. And no, we'll wait till we need the capital. And that second group is regretting some of those decisions. Since you look at private companies today, they're sort of the have and have nots, companies that raise enough money that they won't need to, they're burning cash at a rate that they don't need to raise money for, some cases up to like 3 years. And then you have others are recognizing, wait a minute, I'm going to have to raise money. And even though these valuations are far below anything I would have imagined a year or 2 years ago, I don't have a choice. I need to raise more capital. And so in that world, you're really seeing this dichotomy. But I think for the larger firms, larger corporations, many more were taking advantage of cheap financing, recognizing that would probably not persist. Now, I think most people are surprised where we are today, but a lot of money was raised at very cheap rates. And going back to the long-term contractionary impact of the banking crisis, when these roll over is when you're really going to see. So again, it's a delayed response. Barry Sternlicht told me that 70% of all commercial real estate loans are from regional banks. Right. So when those roll over, it's going to be a very different world. And you see that, I think, throughout many different industries.
Now, some Fed funds have increased their private investments over the last few years, and it's been a rough time for some crossover funds that invest in public and private companies. How viable do you see that crossover strategy going forward?
Well, longer term, I think it'll be not only viable, but I think really important that you have a strong understanding of public markets if you're going to be a late stage growth investor, just because you need to understand that comparable set. If you have a world that now, this is dated information, at one point we had over 1,200 unicorns. My guess is we're probably more like 800 or something today. But nevertheless, these are large, substantial companies that are direct competitors with many public companies. And so I think that crossover model is going to be an important one. Having said that, near term, a lot of people that I respect and friends with put to work an astounding amount of money very, very quickly. Were very valuation insensitive, and in some cases, sort of due diligence insensitive. It wasn't unusual. Hey, Maverick, you've known the company for a long time. You've always said you want to be involved. Well, good news, we're going to raise a new round and we need your answer in 48 hours. What time out? 48 hours? And so we missed those opportunities. We just don't have a process that would allow us to do sufficient work in that kind of time frame. But in hindsight, it's pretty clear a lot of other people weren't doing the work and yet still put the money to work. So I do think you're going to go through a protracted period of time where those models are challenged. The parallel of the financial crisis. So, and I sit on a few different investment committees, so I've seen this in real time, but the investment committee has decided we want a 15% allocation to privates, rate we're at 15%. And yes, we have some capital call obligations, but those will be offset through distributions. So I don't need to worry about that. Well, also when the denominator declines, like you saw in 08, well, that 15%, which did not decline because you're not marked down, becomes 17, 18%. And all of a sudden, I'm not getting any distributions, and yet they're still expecting me to fulfill these capital calls. So if I include that as debt, 18%, 20, 21, 22%. Oh no, I'm way over 15. And as a matter of fact, this is public record. Stanford went out in late 08 and hired a banking firm to help them solve about a third of their venture portfolio. Well, then the Fed comes to the rescue and the denominator goes back up. And by the fall of 09, wait a minute, we're back on target. It's fine. Stanford actually did not fulfill, didn't use that bank or didn't sell anything. The difference this time is there's no Fed to the rescue.
You don't think so?
I don't see how they possibly could at this point in time. And therefore, this is not something that's going to be magically solved over the next 6 or 12 months. And if you look at, again, institutional investors who are overweight, their reaction is going to be either A, I can't make any new commitments. B, I'm going to argue, do I really need to fulfill these capital calls? And C, should I sell some of this portfolio altogether? So the supply demand is going to be quite different in the next 2 or 3 years than we've looked at in a long time. And the good news is if you do have capital, I think there are going to be some really, really rewarding opportunities. But a lot of the funds that have put a lot of money to work very quickly, I think are going to have a much, much more difficult time raising capital than they ever have.
So just to be clear, what do you think crossover managers do with stakes in private companies that now look years away from going public? I mean, are you expecting a rash of selling from these firms on the secondary market?
So the secondary market, this may change, but right now, again, supply demand mismatch, the valuations are well less than half of last round typically. Just it's not true across the board, but it's a generalization. And most investors are refusing to accept those kind of valuations. So you really don't see a lot of liquidity. There's not that many transactions of size actually happening. I don't think you'll see that the crossover investors or even the venture investors are sort of forced to sell. What is going to be the interesting dynamic is watching, as we talked about earlier, is sort of the bifurcation of private companies that have enough cash to last a while versus those that don't, and those that don't being forced to come back to the market. Now, typically they're trying to claim, the headline is same price as last round, but underneath that are massive dilution provisions. In reality, things are being done effectively at 40% down from last round, which is a lot when the company is growing often over 50% a year. So the real valuations people are getting today are dramatically different than what was happening. But you see the same thing in the public markets. All the big banks have these different indices that look at the performance of high growth, revenue multiple, break even, losing money type companies. And the peak of trough for those was sort of 75 to 80%. Now it's from peak to today is down more like 60%. So it's exactly what you've seen in the public markets. And yet private investors just don't want to, either don't appreciate that reality or don't want to accept that reality.
Right. So after 2008, there was a lot of soul searching among policymakers to figure out how do we avoid the kind of drawn out, unsatisfying, long recovery from the early part of the financial crisis. This time around, the COVID shock hits. A lot of money is dropped to try to preserve incomes, build that bridge to whatever the other side of the pandemic was going to look like. What lessons do you think policymakers should have learned or will learn from the experience of these last 2 years?
I hate to say it, but probably not much. I think understandably so, policymakers are going to look at COVID as something they won't have to face again. And that, hopefully that's correct. Obviously, it could be wrong. I say probably not much because I would argue the lesson should be that massive fiscal stimulus was rather short-sighted. And while there were some advantages and got through and help people get through some very difficult situations, which I appreciate. At the end of the day, our economy, in hindsight, didn't really need that. And again, maybe we were going to be in COVID lockdown for 5 years, and that's all. But so hindsight's 2020. And of course, Ukraine and Russia again sort of accelerates some inflationary trends. But I would argue politicians, if they do face a summer crisis looking forward, aren't going to be focused on what was prudent and what was wise. They'll be much more focused on what will help me get reelected. And indeed, if I look at, and I'm not blaming one party or the other, I think on both sides, the trend has been rather consistently to maximize fiscal spending. I mean, the whole movement from the Republican Party a few years ago about balancing the budget and Newt Gingrich and all that has just sort of disappeared. And so they're, Paul Ryan retired for a reason, right? And so, I hate to say it, but I do fear that, again, it goes back to the Fed and why they're just less able to be as effective as they once were, because you used to have a lot more stability on the fiscal side than you do today. And again, those decisions are not being made out of logic or prudence, but are being made for very different motivations.
So during the pandemic, another big shift was you moved down to South Florida. A number of other of your peers have done the same thing. How's that working out? What are the pluses and minuses of being in a warm place where you don't have to step into a pile of dirty snow water in February versus having everything that New York has to offer?
Yeah, I'm as basically a lifelong New Yorker, and as was pointed out by Barbara in the introduction, I've been involved in a few different things here in New York. And the city's been a really amazing experience for me. I'm worried. And the only good news is I think New York's in much better shape than Chicago or San Francisco, et cetera. But some of the trends which have driven the migration, not just to Florida, but to Texas and Nashville and even Wyoming, I think are with us for a while. And so concerns about crime, concerns about the quality of education, the willingness or a desire to be more efficient from a tax perspective. And yeah, the weather's pretty good too, all those things. So for me, I've enjoyed some of those advantages. The flip side is our largest investment office is in New York, second largest in San Francisco. And as much as I can live on Zoom and actually try to get up to New York every other week for a couple of days, it's not the same as being face-to-face. And why a few members of the investment team moved with me, the large majority chose to stay put here in New York. And as I mentioned earlier, it really is an apprenticeship business. So one, that part becomes less effective, but even more importantly, I would argue just sort of the culture and the relationships and the bonds you form just doesn't happen on Zoom. You don't chit chat for 10 minutes and how was your kid's soccer game and all that. And you don't realize, it sounds at the time, you don't think it's really important, but over time you recognize that is part of what creates the fabric of our firm. So there are no perfect solutions.
Yeah, Zoom it was useful there, but it's highly transactional once you get in the meeting room. I want to save time for questions from the audience, but before we get to that, and maybe for some of the students who are joining us online, for someone starting out in this field, what have you found? What would you say are the most important values or habits that would serve someone best if they already know, finance is where I want to go?
Well, this may sound a little corny. I apologize, but I would start just with the importance of integrity and ethics. Once you make a poor decision in that regard, you will be tainted with that decision forever, and it will be, no matter what field of finance you're in, it will impact your career. I think people lose sight of the fact that what we do is not rocket science. Unless you're in the quant world, then it actually is rocket science. But doing a DCF is not that challenging mathematically, and so being much smarter than everyone else is not really the difference maker. It's more thinking strategically, evaluating people, being dedicated. We tend to hire people that are really competitive, that really want to win and are willing to put in the hours, not meaning we want to watch who got in first and who leaves last, but more, are they using their time efficiently, effectively, and are they getting things over the goal line? And then lastly, if you're fortunate enough to be in a place where there are senior people that you respect, take advantage of that and try to soak up as much knowledge from their experience as you possibly can.
We'll go ahead and see if anybody has a question. State your name and affiliation.
Thank you. Shai Hosanzadeh, Onyx Point. You made a comment earlier about decarbonization and deglobalization being inflationary. And I wonder, just given your successes in tech and the great benefit that the industry has realized from cheap energy prices, some $1 to $2 trillion a year, as we transition to this new paradigm of higher for longer, do you see an opportunity, a relative opportunity opening in commodities, and how is your firm positioning for that?
So we've never been active in commodities just because I don't think it really lends itself to our strengths. It's really much more driven by different macro considerations. And we tend to focus on industries where having a better understanding of the competitive dynamics, thinking about secular trends that will persist, allow us to have make decisions that we hope will be more persistent than what you find in the world of commodities. So trust me, there are several points, especially the last couple of years, but even the last couple of decades, where we've missed things. I mean, last year we did a little bit of energy, thought about doing a lot more and didn't, and probably should have. We just have always been shy to be involved in an area where I don't think we have the same meaningful advantages we have in other areas.
Anyone else? If not, I'll resume my others one over here.
Hi, Paul Michalowski from Swag Domena. Just maybe can you just talk a little bit about your thoughts over the past couple of years around shorting? You've talked a lot about the influences of algorithms and others' influences on the market, and your risk tolerance and how you may be thinking about that going into this next cycle.
So as I mentioned earlier, we have a quant business where we looked at alpha signals that we could get from alternative data. And part of the exercise we're always focused on there is if we can predict revenues are going to be better than people think, or earnings, et cetera, what's the correlation between that and how the stock performs? And that's become more challenging. But just putting our quant trading aside, just in general, looking at the market, and again, the correlation between strong fundamentals, so basically earnings or revenues beating or missing, and how the stock price reacts, that correlation at an all-time low during COVID. No one really cared did they beat the quarter or miss the quarter, because we're not going to have a quarter like this ever again. That changed really about July, August of last year. So we've now had 6-8 months of a strong correlation between fundamentals and stock price performance. And that's on both the long side and the short side. And we, and I think other investors that are fundamentally oriented, have had decent periods of performance. And the short side in particular is the least competitive day that it's been in 20 some years. As I mentioned earlier, most hedge funds, although the exposures are back down, but over the last couple of decades, net exposure tweaked up. How I create short exposure, especially after Wall Street bets and all that, the lesson for many was, oh my gosh, I'm never shorting an individual stock the rest of my life. This is too risky, it's too hard. And therefore, I'm using ETFs, I'm shorting futures and creating other ways of negative exposure. But of course, they don't provide any opportunity for alpha. By definition, shorting futures is your short exposure will perform in line with the markets. So we really have doubled down our effort on the short side. It's part of why exposure is pretty low, because we see a lot of really interesting opportunities. And I think it's going to be a very productive time. And this is really the driver of returns, but it is relevant. It's the first time since the late 90s where I actually get a positive yield on my short book, right? I get a positive carry. Hey, that makes it easier. So I think we're on the long side as well, but I think especially on the short side, it's for the first time in a long time, going to be a much easier experience. And I think the odds of another Wall Street bets are quite small, because that was driven by this hyper speculative environment that I don't think is with us, nor will be with us anytime soon.
Right up here.
Hi, it's Steve Looney from E3. You sit at a unique spot with having come up through an education system, and now you're looking at all these AI tools. What do you think the implications are of AI on learning and education and ed tech?
Well, I think, and I'm on the board of a school, high school as well. I think the biggest, and I think this is actually happening pretty quickly, is the recognition that we need to be teaching different skills than we've been teaching the last 100 years. Knowledge will be ubiquitous. And you could argue Google, started this, but it's very different Googling something, getting 6 websites, clicking the website. Is that what? No, it's not. It's like, let's try the next website, versus asking a question and getting an answer. And again, part of this is just the growth of infrastructure and throughout the world. But the thought that in a few years, virtually, a 4-year-old, anyone's going to be able to pick up a device and ask a question and get a really smart, informed answer. So in that world, what is the value of memorizing every moment in history? What is the value? And instead, how do you prepare young people for a future where depth of knowledge is not the driver of adding value and success, and recognizing that using that knowledge as a tool more effectively than those you're competing against is a skill set we need to be developing. And then in the shorter term, the day and age of, hey, over the weekend, please write this term paper, that's gone. And all ChatGPT and others are trying to build in sort of watermarks where you could tell, and I know that schools actually have already used some of that effectively to recognize, but once you have 4 or 5 of these, and I don't know to what degree people play with it, it's pretty amazing. Write da-da-da, and I want every word to contain the letter I. I want every third word to have 2 syllables. I mean, you can make up so many parameters, it just responds, no problem. And so I think you're going to be back in the old school of you walk in the test and Johnny's given some paper and a pencil, go write your essay answer, by the end of class. So there are going to be those kind of near-term changes as well. But if you're an educator and you're not really thinking about how this impacts what you want your young men and women walking out of from your institution and what skills they need, you're not doing them a service. It's a different world.
So we do have a question from someone online, which was, how do you think the Inflation Reduction Act will affect the economy? So
this is not an opinion unique to me, but I would argue that term is an oxymoron. And indeed, it was yet another example of a short-term response that has longer term. I get the argument that you could argue it reduces spending, but in the first 2-3 years, without question, it's another fiscal stimulus at a period of time where we didn't need the fiscal stimulus and just works against the efforts of the Fed. But that's the reality of our political system.
Well, why don't we wrap it up there? That was just outstanding. Many thanks to you both. I just want to give a quick rundown of our schedule for the club going forward. We have the CEO of Merck, Robert Davis, virtually on April the 25th, talking about the future of biopharmaceuticals. I'm sure he'll talk about the acquisition over the weekend. April 26th, we have our complimentary prospective member event. That'll be here at the club for qualified candidates to come meet club leadership. May the 3rd, we have Daniel Huttenlocher, the Dean of MIT Schwarzman College of Computing, and he will be talking about AI. On May the 9th, John Williams will join us for a luncheon here, our chair and, of course, the head of the New York Fed. Askana Markarova, the Ukrainian ambassador to the United States, will be joining us May the 17th. And then, of course, Henry Kissinger. We're going to all celebrate his 100th birthday. And he's also going to do a fireside chat with Marie-José Kravis. That'll be May the 23rd, a signature luncheon. We have a number of members that are hosting peer exchanges. And so keep your eyes out for those. This is a new program where members can suggest topics and then host other members in their boardrooms or in their homes or other venues. And we organize them here at the club. So finally, we always like to take a moment to recognize members of the Centennial Society joining us today as their contributions continue to provide the financial backbone of support for the club. So thank you all that attended virtually. We'll say goodbye for now. And for those in the room, please enjoy your lunch. And everyone, we hope we'll see you soon. Thank you.